Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and I'm doing our housing weekly market update. I hope everybody's doing well. Hope you had a great Memorial Day. I'm going to jump right in here, start sharing my screen with you. I've got some really good things here. I'm going to talk about, can we see a housing crash? What's going to happen? This Iran thing goes on any longer with the conflict. What can we expect from this housing market, Chris? What's happening? I get a lot of questions. So let's jump in here and take a look at some of the news. Okay, so first of all, again, I showed this to you last week. Poised for growth if 2026, if Iran conflict doesn't raise rates. Mortgage rate, this is from Logan Monashami over at Housing Wire. Mortgage purchase apps has been positive year over year every week. Housing Wire weekly pending sales has remained positive. Now, this was back on March 11th in a CNBC interview. And remember the trifecta for the Trump administration for the economy was lower dollar, lower energy and oil prices, and lower interest rates, Fed rate, mortgage rates, the whole thing. Okay. So let me go ahead and share the screen here and show you what's going on. All right. So why a 2008 housing crash can't happen again. And this is from Logan Monashami over at Housing Wire. Because a lot of people, you've been hearing this. I've got a graphic for you here. You've been hearing this for a while. Shadow inventory, 2012, we're going to have a crash. In other words, the shadow inventory is going to come out of nowhere. So basically, from the last housing crash, or the only housing crash we've ever had in U.S. history, okay, there was one other year where things were kind of flat or went down about 1% nationally. Other than that, we pretty much had, one real, great financial crisis housing crash. Shadow inventory, 2013, higher mortgage rates, QE ending in October. These were all the excuses from the mainstream media that we were going to have and all the experts. Now you have the clickbait bros out there, the doom and gloom housing crash bros out there. There's a lot of them out there that they get lots of clicks and everything, but manufacturing recess in 2015, home price got back to the bubble high. I'm not going to read through all these. We had COVID, we had mortgage forbearance, 7% mortgage rates, all these things were, sexless men was the one from a couple of years back or into last year. All these excuses of why we were heading into a housing crash or a bubble and crash again. Well, none of that happened. Obviously, we since the great financial crisis. And Logan Monashami basically gets into this, and he says, to summarize this, post-crisis rules, including bankruptcy reform and qualified mortgage rule, narrowed the path to a 2008 style blowup, with a 30-year fixed mortgage dominating and borrower credit profiles staying strong. The housing credit setup differs sharply from 2002 to 2006. So, in a nutshell, I'll kind of nutshell this down for you. Here, by the way, again, just so you can see it, this is the years of the housing crash and the percentages they went down. He had one other year here in the red back in 1990, went down 1%. Other than that, going back to 1942, we've had positive appreciation on homes. Okay. He says here home prices rose faster from 1977 to 1979 when mortgage rates went from 8% to 13% than 2020 to 2022 when we had sub 4%. So there's a stat for you. But just looking at the data, you can't really argue with that. So where's my other stat here I wanted to show you? So looking at this, he kind of pointed this out this week. New listing data that people use for the mortgage rate lockdown premise were lower in 2021 than when rates were at 3% than in the last 2 years when rates were above 2%. Okay. So, in other words, we've got this idea out there that people are locked into their mortgage rate. I understand people will say that from time to time, but are they really truly sellers? Some of them may say, yeah, I'd like to move, but for us, we talk to people all the time and, they say these things, but they're not really serious about moving. And there are many ways of getting a lower rate right now. One in particular is just talking to a mortgage broker versus a retail mortgage person that's seasoned and that doesn't charge you the high fees. I mean, you can get 100 basis points knocked off just for that alone. You can buy a new build today, that are offering, 4% interest rates. You can negotiate this into deals where we have gotten for many of our home buyers, anywhere from, 50 to 100, even 200 basis point lower knocked off, even when they're working with a mortgage broker. So there are a lot of these ideas, fallacies. Maybe some might even call them excuses. I like to say they're problems we can solve if somebody's serious about wanting to move. And that's where the kind of the rubber meets the road. Are they really seriously a buyer? Are they really serious about thinking about selling and buying? That's really the question, I think, from my anecdotal experience, just saying anecdotally, I think, are they really serious or not? Because if they are, we can make it happen. We know how to do that. And these statistics just don't bear fruit there. Now, the other thing too, just along these lines, and I'll get back to the housing crash thing here in a minute, but mortgage rates broken down across the country in the US, more people have rates over 6% than 3% or lower. So again, just doesn't line up with the data of where people are really at. Okay. And now with the fact that rates did come down, they have come down. They're still down compared to where they were the last couple of years. People had options to refinance too if they were really serious about doing that, all these things, or moving or whatever, or buying, or selling and buying. So, but the regulations for the 2005 Bankruptcy Reform Act and qualified mortgage rule. In other words, you have to get pre-qualified. You couldn't just fog a mirror and buy 3 homes with stated income that nobody saw on paper, like before the crash, which was a big part of the problem that kind of rolled this up, along with super high overbuilding and way, way overbuilding, too much inventory. You had all these regulations that came into place. Some of them probably, some will say Dodd-Frank and some of that reform was overdone. I certainly think some of it was overdone for sure. But in 2010 and 2000, starting in 2014, they had these new rules and regulations, pre-qualified mortgages. You had this Dodd-Frank thing. You had the bankruptcy reform in 2005. So these laws changed things. Foreclosures and bankruptcies right now, if you look at this chart, here's the great financial crisis period right in this zone here. Obviously, they were elevated then, okay, and even leading into it, you can see there. But now we're way over here. We're basically at low pre-pandemic levels for bankruptcies and foreclosures. So the idea that the percentage went up, sure, it went up because during COVID, right in here, you didn't have any going on. So over the last couple of years, yeah, you've had an increase in the percentage, but in the actual numbers, you just didn't have this great number. Every balanced market, every normal market, real estate market is going to have some foreclosures in it. It just, you're always going to have foreclosures. It's kind of like taxes and death. All right. But a 30-year fixed rate mortgage, you've got, the housing bubble. You had all these fancy loan programs that, went beyond like what we have today with ARMs, where you have to qualify for a higher amount and things like that, to qualify for this pre-qualified mortgages. They were taking people with these lower credit scores or no credit score, really figuring things in like we do now, debt to income ratios, all that sort of thing. So you had these creative mortgages that came into play, stated income, all those things. And we still have we have some of those sort of things, but there's some safeguards built into that. You still have to qualify again for potential on an ARM, a higher mortgage rate. So it's a little different. There's still debt to income ratios that come into play. You still have to show, W-2s, or you still have to show pay stubs or income stubs, things like that, that weren't those safeguards into play before. High credit scores right now are dominate the mortgage field. Okay. You can see the difference here, for higher credit scores. All right. And the conclusion again, the deal with people's what they're putting down on homes, again, what their credit scores are, where the interest rates are. Another big thing too is the average home buyer, or I'm sorry, homeowner has about on average $295,000 in home equity. This means it gives them options, right? They can sell, buy somewhere else. They could take some money out, buy another property, as long as they qualify with their credit scores. They could take out HELOCs if they are having financial issues, and use that based off lower credit scores, to get through a rough patch, and use that as kind of like a credit card. So with this sort of cushion here, as it talks about, nearly half of all mortgage residential properties are classified as equity rich, meaning the outstanding loan balance is less than 50% of the home's value. So, and it says here it had a slight decrease with the overall, and a lot of that deals with homes in the South, this past year or two, uh, lost a little bit in equity, because again they have super high inventory there. And when you go back and look at the crash, you will see also this isn't mentioned in here. Not only are people equity rich, you've got all these regulations into play that we didn't have before, uh, but you also have the idea that we had a ton more inventory back then because people were, they overbuilt. They overbuilt. We had too much brand new, fresh, real fresh inventory. And then on top of that, because of these poor lending practices to eat up that inventory that came into play, they brought in all these crazy mortgages that, really had no qualifiers in place. Like we have now for pre-approved home loans. You have to be pre-approved in a big way. It's still pretty easy, but it's much more robust than it was before. That you had this overbuilding, brought in the crazy mortgages, no not really pre-qualifying people properly, and then people lost their homes or multiple homes, and they weren't going and buying another place. They were having to go live with family or rent because of that. So you had 250 to 450,000 homes going on the market every week, where normally you'd have, in the average historical normal market, you might have 80 to 110,000 homes going on the market every week. In the Phoenix area, we had like 58,000 at the peak of the crash. We had like 58,000 homes for sale, where normally for us, we might have like, in a normal market, rule of thumb is about 2,400 a week, new inventory coming on the market, or and that's including resale, new homes, but 2,400 a week coming online, and you might have anywheres between 20 to 30,000 homes for sale in kind of a normal market for the greater Phoenix area. So we just don't have those sorts of activities, those sorts of data points, those sorts of things happening in our local or national market. And we've had all these other regulations in place. So just keep that in mind for the housing crash bros out there that making a good living off their clicks. this is the reality of the situation. Okay. Things are definitely tough out there. Everything's less affordable and all that. But when I didn't pull up the charts, I probably should have. But for homeowners, we see that they're way, way, way less in the way of um, credit card delinquencies and car loan delinquencies, things like that too, which are obvious indicators because, again, another data point would be that a homeowner is about 44 times uh, more has more 44 times more wealth than a renter. Okay. So they've got this, you don't invest in the stock market. Maybe you have a 401k, maybe you don't. You don't really invest in the stock market. Most people don't, or, other things and in the equity markets and stuff. But, most people can go out and buy a home if they do a little bit of work and research into it and work with a realtor, work with a lender in order to do that. So you gain that equity, you get that compound interest too, because your mortgage rate stays less, or theoretically you can refinance and even lower the payment possibly. And then you don't have your rent going up every month. You're paying down that debt, eventually paying it off. Okay, while the equity is going up. uh, over the history of all housing, except for that 4-year, 5-year period that I showed you there on the chart, you're going to see that you have those equity gains. And you think about it, when you take and put that money in as your down payment, and they even have down payment assistance programs. So in some cases, not even doing that, or if you're VA, but if you're putting down that down payment, just think of the percentage that you're making back with your equity. Just in a 5-year period, it could be 30 times return. So anyways, just looking at the average numbers. So anyways, getting back to the market. So no, there won't be a housing crash. There's just not enough inventory. There's not the other atmosphere that we had before the crash and things like that. But we did see some single family home construction cools, builder sentiment inches uh, higher though. Pending home sales keep climbing. Fed minutes highlight policy divide because they're wondering what's going on with the whole Iran thing, for one big reason there. And a pulse check on unemployment. So housing starts fell nearly 3% from March to March to April. Sorry. Building permit, a key indicator of future building activity, rose 5.8%, led primarily by multifamily projects. Okay, so not single family permits declined. Okay, so bottom line, overall, the data suggests builders are taking a more cautious approach amid ongoing economic and geopolitical concerns. Iran, energy prices, 10-year treasury, mortgage rates, Fed rate, which comes into play indirectly for your 30-year mortgage, but also for builders, any business that needs capital to borrow money. Okay, the overnight Fed rate. And what is the Fed policy? Well, we're going to see, we have a new Fed chair. We'll see what that's going to be coming up. I think you're going to see a lot of changes made there. Like right now, I could see why a lot are, wondering how long this Iran thing is going to go on. Quite honestly, I think it's great that we're doing this with Iran. I just wish it would be over faster for the overall economy. But we'll get more into the inflation numbers here in a second. But home builder confidence ticked up in May, raising to 37 points, while still below the 50% benchmark that signals expansion. The index showed modest gains in current sales, future expectations, and buyer traffic. Bottom line, higher mortgage rates, rising gas prices, all the things we've been talking about. They see that things could be moving forward, obviously, but right now they're cautious. Okay, bottom line. Pending home sales keep climbing though. Okay, pending home sales, a key measure of signs contracts on existing homes, increased 1.4% March to April, beating expectations, marking the third consecutive month gain. Sales activity was also up 3.2% compared to this time last year. The Northeast and Midwest saw the strongest growth monthly growth, while activity in the South slowed slightly, which we already know they have a lot more inventory down in the South, places like Florida. Um, Despite the economic uncertainty and higher mortgage rates, buyers are showing cautious optimism, according to Lawrence Yun and the National Association of Realtors. She's the chief economist over there. Yun added that demand could strengthen even more if mortgage rates move closer to the lower level. So what we've always said is, along with Logan Montashami's, because we can just see it as things flow. But when you get rates to about 6.6%, and you see the 10-year treasury right around that 4.6 mark, this is when we start to see things maybe slow a little bit, more cautious activity. When the mortgage rates hit that 6.6 mark or 10.6 in the 10-year treasury, which they work hand in hand, and that we call that the spread between the 10-year, 30-year mortgage rate. Okay, so what we want is to be below that number. When we're below that number, we see pending home sales, mortgage application data, all that stuff goes up. And we see more closings, more home sales. We see more building going on at that point. We were, for the national mortgage rates, we were down just below 6% just a few months ago before this all started. So um, the Fed minutes, the Fed is basically divided. You got Kevin Warsh coming in, Stephen Myron, who will no longer be there. So really, the only other dove, coincidentally, is oh, what's her name? The one that was under investigation, Lisa Cook. She's the only one that's really been dovish. We'll see. Some people are saying that Kevin Warsh may be kind of forced into raising the Fed fund rate, maybe being a little bit more cautious, hawkish initially to kind of set the tone and show people he is bipartisan, or not bipartisan, but independent. Um, with if these tensions are still going on, their Fed meeting is the 16th and 17th of next month. We'll see how that goes. Obviously, he doesn't set things on his own. There's going to be there's 12 members, seven of them, including Kevin, or along with Kevin, get to vote on the Fed fund rate, whether they're going to raise it or lower it. Some people are calling for a 0.25% rate hike. So we'll see how that goes. If this, I was thinking, now I don't know if it's true or not. We'll see officially how this comes out, but they're talking about a 60-day ceasefire now, agreement actually in writing, solidified. If certain things are in place, we'll see. I don't know if that's the case yet. They haven't officially come out with that, but I was kind of thinking this whole thing might be tied up before the next Fed meeting, or at least before the 250th anniversary, July 4th. Obviously, that was kind of the benchmarks I was thinking of, one way or another. In other words, we were going to go in and do more military action, or they were going to have an agreement. Keep in mind, it is hurting our economy, but for them in Iran, they're like over 250% inflation right now. They're losing $500 million a day. So even though we don't get the oil from there, we're tied in with the global markets. Unfortunately, that's just how some of the people tied us in with that. Even though we produce enough of our own oil, and we actually was it 900,000 barrels just arrived in Japan of oil from the United States, and we've got over 100 ships, I guess, coming into the Gulf to get oil from us, or have come into the Gulf to get oil from us. So what's the bottom line overall? We'll see where they end up next month, and depending a lot on where things are with the Strait of Hormuz and getting the oil flowing through there again. This is all tied in with the global markets. As far as unemployment, because the Fed looks at inflation and they look at jobs, full employment. So right now, newly unemployment claims remain relatively low, 200,000. We had about 300,000 jobs added over the last couple of years. I'm sorry, last couple of months. We had 2 months ago, we had 15,000 manufacturing jobs added, because the Fed really, two indicators for a recession would be your construction employment and your manufacturing. If those two are hurting, you could be heading into a recession, already in a recession. You usually find out you're in a recession after the fact. But we see those two are actually up a little bit, 13,000 overall, because there was a 2,000 revision from last month on manufacturing. Uh, Construction is up slightly, not a lot, but slightly. So that's good. Again, this thing ends, Fed rate comes down, oil, energy comes down, 10-year treasury comes down, Fed rate, Fed messaging is more dovish, probably not accommodative, but maybe neutral to begin with, and then going into accommodative because of, you know, what I'll show you in a second here. But behind all this, the regular economy, because this is not inflation, this is a supply shock to the global economy. Inflation has to do with too many dollars chasing too few goods. A supply shock, a tariff, those are one-time possible price adjustments. So just please keep that in mind, because people keep saying inflation, inflation, but the underbelly, the base of our own economy, I think we'll see when this all gets unlayered. And even when the Strait of Hormuz opens, we're probably going to see at least 1, 2, maybe even 3 months before things get back to normal. Okay. But once we get there, we're going to see that the inflation rate is lower. We're going to see rates come down, 10-year treasury, oil prices, energy prices come down. So we're going to see more hiring, as then we'll also see the Fed rate come down. And it's one of the biggest things that can hold up production, that can hold up manufacturing, that can hold up construction on homes and things, and in commercial construction too. So Fed Governor Michelle Bowman warns against hiking rates, interest rates, because of inflation spike. Federal Reserve Governor Michelle Bowman on Friday cautioned against raising interest rates um, to address the current spike in prices, reacting to temporary, not normal inflation, temporary energy price inflation would add unwarranted policy constraints, okay, weighing unnecessarily on economic activity, labor market conditions, the policymaker said. And this is basically what I just said, okay? Because again, businesses need capital. If it costs more money to borrow that capital, they're going to be less apt to do it, or not do it at all, or do it at a slower rate. That's less hiring, that's less production, all that. Sure, does AI come into play? We saw that with Facebook, sure. But I think most people are starting to figure out that although some of the jobs may go away, we're going to see that that just like with every technology, a lot of this stuff, and I would say it's not going to have an impact at all, but I think we're going to see that just people are just going to have to figure out other avenues to take this by using AI. I can tell you, we use chat, starting to get into Claude, which looks a heck of a lot better. We use it for our company. It is amazing how fast you can get stuff done. It basically kind of replaces an assistant in a lot of ways. So yeah, I could definitely see that as a marker. But manufacturing employment bounces back, adding 15,000 jobs. Like I said, they took out two. Crude oil. Um, Over the last month, though, look at the slope down there. Okay. Just with the most recent news. Now, that could snap back at any time, obviously. I know, for the doom and gloomers, we know that there could be volatility there. We'll see how things go. But look how that sloped down. Okay. And, over the last 6 months, we can obviously see how it's gone up too. Um, but just in the last week, we've seen a little bit of a slope down. Today, we had little up and down. This is just in one day. Look at all that. So we'll keep an eye on it. We'll keep an eye on it. But 87 is better than 110 or whatever it was before. Just in the last week. I mean, we were up here in the last month. Look at that. We were all the way up to, like, 110. So we'll keep an eye on it, guys. Keep you now. Here's the big deal. I keep bringing this up because I want people to see what I'm talking about. The shelter costs. This makes up a third of the entire underbelly of inflation. Now, I don't agree, and many do not agree, and you'll probably see a change in this, along with a lot of other things at the Fed coming forward with, better, more real-time data. You're going to see, more real-time data brought in. You're going to see this be brought up a lot, especially once this Iran thing's done. And the underbelly of one third of inflation, the inflation rate, we already went up to the higher inflation number or levels. Okay. But when you talk about inflation, I talk about the rate of inflation. Is it going up or down? Okay. Inflation, you will always have with you. Yeah, you can have deflation. And some think like, um, what's his name over at Amazon, Bezos, that we may even with AI even see deflation. We'll see if that ends up happening, but I'm not going to get into all that. But you can see with the shelter cost over the last 3 years, this is the last 3 years, it's come down considerably. The rate of shelter again goes back to the 1980s. They call people, get surveys on rental prices. That's how they do it. It's archaic, antiquated. These are some of the things I think we'll see changed at the Fed. But and when we see it at the Fed, well, I think we're also going to see those changes, more real-time data, better data, more fullness of data, not just a survey over the phone where how many surveys are you really getting over the phone about rent? I've never been called. I don't know. And how many people really know how much their home would rent for? A lot of people might know around what their home could sell for, possibly. Everybody always adds a little bit. But did they really know what it could rent for, and who are they talking to? I don't know, but we have much better data, real-time data sources with AI, with things like MLSs, Zillow, all these other real-time data sites. So, anyway, just something to think about. U.S. Treasury right now is at 10-year Treasury is at 4.443%. And we can see some of the volatility there over the last year. This is over the last month. You can see how it's come down. That's good, along with those oil prices in the last 5 days. Woo, look at that, guys. And just in the last day, here's where we are. Just kind of, we were up here, now we're down here. Okay. I like down. That's better. Now, this should be normally about a 1.6 to 1.8% spread between that and the 30-year. So let's see where we're at. This was an article I wanted to show you real quick on the mortgage rates. Officially hit 2-week lows on mortgage rates. Okay. We want to go crazy over that or not, but right now we see, let me pull up the full chart here. 30-year fixed is at 6.56. So the spreads are a little worse. Obviously, the economic impact of all this than that 1.6 to 1.8 spread where we should be historically. We're at about 2.1 and some change. So that's something to keep in mind. But, as Logan Motoshami puts it, let me see if I can find the right one here for you. There we go. This, since the end of 2022, whenever mortgage rates drop below 6.64% and approach 6%, housing demand improves. However, that fades when rates rise above 7%. In the past 11 months, this has been the lowest mortgage rate curve since 2022. This is solely due to the mortgage spreads improving. So we can see where we are in 2026 here compared to the last couple of years. Obviously, that spread is much lower, and we can see why we're not in the sevens right now. And we would have almost been close to 8% over the last couple of weeks. So that's good news. Thank you for a hug and mortgage spread, as Logan puts it. The other chart I wanted to show you here was, the national housing inventory, and this is basically almost the same as here in the Phoenix area. We can see it's kind of leveling off right now. Inventory growth is now at 0.89%. So it's heading, way down. This was up to 32% last year, guys. Earlier this year, we were in double digits. Now we're at point 0.8, under 1%. So this is going to probably end up going negative as far as, but we have enough inventory backdrop where we shouldn't see too much of a problem there. But real big story there. This gives less options to home buyers, a little bit better advantage for sellers overall across the country. Northeast is going to have highest advantage to sellers right now, and Midwest, as we talked about earlier. The weekly pending home sales for this week, 70,000 I'm sorry, 70,209 for weekly pending sales. Okay, so we can see how it kind of was going up, and now it's kind of just leveled off a little bit there. All right. Still higher than last year, not by much, but still higher than last year. Looking at this was just last week. Mortgage rates not rising above 7% or staying too long over 6.6% can explain this, where we had kind of a leveling off, but we're still higher than we were last year, last week. But we can see how that's dropped off by 9,000. Okay. So something to keep in mind there with what's going on with the market. Also, some of that's seasonal too, but right now we're kind of running towards the end of the peak selling season with schools letting out. In the Northeast, they're obviously going to be 1 month later than us. Okay, this is something I just wanted to show you. Building construction, it's kind of up a little bit, but not by much. Okay. Talked about that earlier. Purchase application data. This is always a leading indicator. People getting pre-approved for a home loan. Flat week to week, 5% year over year. So we're still up year over year, but flat this week. Housing held up okay during this 0.76 increase in rates when the lows to the peak. So you can see mortgage application data for 2026 was way up at the beginning of the year. Then we had the whole Iran thing, and it's kind of done this little snaky thing. And now it's kind of leveled off, but we're still higher than we were last year. Okay. So there's more buyers out there in the market. Some of them are probably sellers, yes, but they need to sell their house first in a lot of cases. But total housing inventory, Cran Economics was created to teach those who would rather burn books instead of reading them. Like Logan says, you can kind of figure this out if you just kind of read the real data. That's why he's saying that. But you can see, how our inventory has really dropped off in a big way since the crash, where we had too much inventory. And we can see these lines here are all recessions. We can see, where things dropped off. And even down here in 2020, but with COVID and everything, where we had pretty low inventory levels, but we had a lot of buying going on in 2020, 2021, especially into the beginning of 2022. And now our levels are nowhere where they were, obviously, with total housing inventory going back to the crash. So this idea that we're going to have a crash, not a thing. On the housing side, again, he says, these qualified mortgages, kind of what we were talking about earlier, made the big difference. And there's the chart again on why we're not going to have a crash. So for the Phoenix area, like I said, we're basically running almost alongside with what's going on with the holiday and everything. I didn't have time to put together all the charts, but this is a chart I showed you from last week, 2026. Closed units are up 3.9%. Total volume up a little over 7%. Median sales price has been flat at 0. This kind of gives you the idea in the greater Phoenix area that home prices are kind of flat right now. But the average, okay, instead of the median, let's look at the average. The average sales price has actually gone up just over 3%. Okay. The normal for us here in the greater Phoenix area is about 4.5%, right around that 4.5, 5% per year over the history going back to the 80s for Phoenix. So, uh, list the sales price ratio again, 97.32. Uh, you know, active inventory again, right around that. This is actually a little lower right now. And average pending home sales are up a little bit. They were up 20% this week, but we're going to see where this kind of goes and the actual closing rate as we kind of get into this next phase. With we mentioned with this Iran thing, if it went through that March 20th date, we're going to start having problems. If this goes on another couple of months and those ships are not flowing to the Strait of Hormuz, we could really see some serious economic issues globally. We really got to get those ships moving through there. So that's going to be really the big thing, guys, to look at. I kind of went over all of this already. Right now, let me just refresh to see if they got an updated one for today. No, this is from yesterday. Cromford Market Index is telling us we're still in a buyer's market. Right now, though, in the greater Phoenix area, we're just under 4 months supply. Now, historically, a rule of thumb is, under 4 months supply in U.S. housing, Phoenix area, it's a seller's market. But they're saying the climate right now kind of feels like a buyer's market. A lot of that plays into that median sales that are going on. And then the idea that we have interest rates going up. So this plays into part of their algorithm here, but supply index is at 106. Truly balanced here would be a balanced market would be at 100. So we're 9 points lower than that. We're 6 points above that 100 mark on the supply. And the demand right now is 13, about 12.5% down from that balance. So if demand and supply were both the same, this number would be at 100. Okay. So some areas, some homes are experiencing, I know, different price points. They're kind of all over the place. We've had properties go under contract in 5 days. We've had other properties that may take a few weeks with some price reductions because sellers had some aspirational pricing, money they need to get out of the house, and buyers just don't care how much, unfortunately, you need to get out of the house as much as how they feel, with their budget and what they're going to try and ask for when it comes to concessions. Also, that's another big thing, not just price, because that list sales price ratio, that's one thing, but are they asking for concessions? And they can use that money for any number of things. They could use that money to help buy down rates, pay for closing costs, other things. But anyway, that's something that an agent can go over with you. I mean, we could show you even how many showings have been in your area. So every area is going to be a little different, but right now this is the sentiment across the valley. Contract ratios. We have active to what's under contract. That gives us a ratio. And right now we're in the warm mark by about 7.7 points. So we're not cold, but we're warm. And we're at 37.7 right now on this index. This is more of the real-time data. And then if we look at the overall chart, we can see, we've got some hot areas, like up here in Phoenix, 85028, 85040, Phoenix 85045, over here in Phoenix 85037. Another part of Phoenix up here, and everything else is pretty much in a cold area. Down here in South Phoenix, it's a little hot, but I can tell you when you position a home properly, you price it properly, it's very, very easy to, get that property under contract. It just has to be, marketed properly, priced properly. and present properly. You want to make sure the home's obviously cleaned up, to take away a lot of the clutter. I'm not so much into, hey, you got to depersonalize everything, because you take the stuff off walls and everything. It kind of, you know, it doesn't make it as warm and as homey, I don't think. And also you've got to patch holes, and stuff like that. So just things to worry about, but we can help with that. The staging, with professional photography, videography, drone footage, all those sorts of things that we can do to help things come into play. For buyers, first thing we want to do, is go over your budget with the loan officer, plug that into a home search that makes sense for your budget. If you're selling a property, we obviously want to look at what kind of equity is there. Does it have solar? All those sorts of things that are going to come into place. At least as it owns solar. Then we're going to want to talk about the marketing. For marketing, we want to do stuff that cuts through all the noise. Some of the old school stuff still works as long as it's done properly, whether it be door knockers, mailers, open houses, as long as they're promoted properly, digitally, online, syndicated, through the MLS everywhere, obviously. Um, with those professional pictures and videography. And then we're going to also want to look at social media, of course, because a lot of that's going to play into also the AI that people are using today in order to search for homes. So if you're thinking about, selling your property, if you're thinking about buying, now might be the time, believe it or not, because think about it. What's going to happen now? Let's say this thing drags on for another 2, 3 months or whatever, one way or another, it's going to get solved. So once that happens, whatever the time frame is, okay, the oil prices are going to drop, the 10-year treasury is going to drop, the interest rate's going to drop, the Fed's going to drop, all that is going to happen because, like I showed you earlier, the underbelly, those shelter costs are down. Okay, now it's inevitable that the interest rates are going to come down eventually. I think sooner rather than later. So if you want to get ahead of that, want to move on to where you are, gain that equity where you want to be versus where you don't want to be now. Okay. There are ways to get the lower interest rate. Okay. So we don't have to worry about, hey, I have I'm going to have a higher rate and all that. There are ways we can work through that in order to make that happen. So feel free to reach out and get ahead of that, because once that happens, it usually takes people about 6 months to figure out what's happening. Okay. I remember during the whole COVID period, it took people, same thing, about 6 months to figure things out. And then they started jumping in the market and went crazy. So, what's going to happen then? Home prices are going to, continue going up. They're not going to come down. I think we've pretty much hit the flattest of the flat that we're going to hit, for the most part. Get ahead of this now and beat all that competition. You're going to be competing against other people. You're going to be paying higher prices. You can always refinance later. All these things come into play. So if you're interested in talking with us about that, we could get into all the details of what it would look like to sell your home. We can break it down for you, get into what concessions that people are paying for in your area, how many showings are happening, and what price bracket. Put your home in a position in a price bracket that makes sense, because people are searching 25, 50, $100,000 price brackets. They don't search for, something at, 529. Nobody puts that into a home search. So we really want to make sure that, the way people are getting qualified, the way they're searching for homes on these portals and AI, that it makes sense. So guys, if you have any questions at all, feel free to reach out. We can put together a strategy for you. They'll be able to tell you, who's probably going to be buying your home, target that audience of people that are going to be more in tune with your home, buying your home, and who that home buyer may be, and where the pricing strategies come in. We have 3 different pricing strategies that we'll prepare for you, and kind of go through that, and what that looks like, what the timing will be, all those sorts of things for home buyers out there. a lot of different strategies to get you into a home, whether it be down payment assistance, whether it be getting you a lower interest rate, or both. We can certainly work that in. We even have a program now where, let's say you're VA, you're already getting your down payment taken care of, or you're a buyer, you've already got a down payment. There's a grant program out there, free money. You can get $10,000 to use towards your home purchase. Now, that money can even be used to pay down credit card, car loan debt, to boost your credit scores, um, to help it make the move more affordable. It could be used to buy down your interest rate. Could be used for, paying your closing costs. Could be used for any number of things. So feel free to reach out to us. And there are a lot of ways to get this done. So we're all about solving problems, or having solutions for what may be holding you back right now. If you have any questions at all, feel free to reach out anytime. We're happy to help. Sit down with you at our office, at your home, and go through all the different strategies we have. So we'll talk to you guys next time. Thank you so much.